This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody. Welcome to Bloomberg Businessweek Daily across Bloomberg platforms, radio, TV, YouTube, Bloomberg Originals. Yes, indeed, it is Tuesday, April 14th, 2026, and we've got a rally underway. We're up more than 1% on both the S&P and the NASDAQ 100. In fact, the NASDAQ on track for its longest streak of gains since 2021, Tim.
Yeah, the S&P up more than 1% right now. Still, energy, materials, consumer staples, and utilities are lagging. Perhaps it's no surprise that energy is down, Carol. If I do GLCO go on the Bloomberg terminal, we are seeing energy down, with WTI down 7% right now, $92 a barrel. Brent at $95 a barrel. That's down 4.3%.
Yeah, it's all about optimism, right? That the U.S. and Iran are considering another round of peace talks that pushed oil lower. Tim just mentioned that. We've seen stocks globally lift. So we'll see whether or not this trade continues. So no doubt about it, markets and really the macro are front and center for us during this first hour of Bloomberg Businessweek Daily.
So ahead this hour, we're going to head to the IMF spring meetings in D.C. and two views from veterans on the macro and the global economy.
Yeah, one of them is our own Francine Lacqua. She has seen
She's standing by
and reported on so many great market cycles. Hey, also, we're going to get the latest quarterly updates from the big banks. And then we have several voices tying all of this together for us.
Founder and CIO over at Asterozoa Capital. Also, Alli McCartney back with us. She's going to be joining us in the studio in just a minute. She's Managing Director of Wealth Management and Private Wealth Advisor with Alignment Partners at UBS.
And let's not forget Ellevest's Emily Green. She's back with us to talk about the great wealth transfer, but also tying it all against the big macro backdrop.
All that ahead over the next hour right here on Bloomberg Businessweek Daily. First up, back to those markets we go, into Charlie Pellet in the Bloomberg studio. Hey, Charlie.
Jim and Emily, here's what's going on. We have got the Dow, the S&P, NASDAQ all advancing right now, trading close to session highs on the S&P, up 76, 69.62. Right now looking at an advance of just about 1.1%. Year to date, the S&P is now higher by 1.7%. The Dow up 302, up 0.6. NASDAQ up 1.8%. The NASDAQ 100 index, the winning streak continues there, up 1.6%. All of this with a VIX above 18 and a 10-year at 4.25%. Spot gold higher by 2%, now $48.35 the ounce. Crude, the big story, now down 7.4%, back below $92 a barrel, $91.77 on WTI. Barrel of Brent, $94.95 now. It is down by 4.5%. Lots of earnings to sift through from banks. JP Morgan Chase today, after earnings, down 0.6%. Their traders did post their highest ever quarterly revenue in 3 months of the year, in the first 3 months of the year, but the stock is lower, down by 0.6%. Citigroup traders rode a wave of volatility to push the Wall Street Bank to its highest quarterly revenue in a decade. Citigroup shares surging today by 3.4%. Also out with earnings, Wells Fargo, the stock tumbling today by 4.5%. Again, recapping here, stocks higher, just about the best level on the S&P, up now by 1.1%. And for on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Got it, Charlie. Thank you so much. Carol Massar, Tim Stenovec, live here at Bloomberg headquarters on this busy Tuesday. Although, again, markets seem pretty comfortable.
Everything's fine. I'm told by the markets.
Everything is awesome. Is it really? I don't know. We'll know more when earnings get underway. But we've got a lot going on in the nation's capital. We've got big meetings underway.
Yeah, European Central Bank President Christine Lagarde said higher energy costs have pushed the Eurozone away from the ECB's base case outlook, though not enough yet to warrant leaning toward raising interest rates. Lagarde said the ECB has to be completely agile and ready to move in the direction that's required and will be data dependent in deciding its next steps.
She talked with our own Francine Lacqua on Bloomberg Television earlier today in Washington, where both are attending the IMF spring meetings. Madame Lagarde addressing today's environment and her plans to stay on to carry out her ECB mandate.
When there is big clouds on the horizon, the captain does not leave the ship. And this captain is not going to leave the ship because I see clouds.
And that, of course, is President Christine Lagarde at the IMF spring meetings underway in Washington. So, too, as we mentioned, is Bloomberg's Francine Lacqua. She is host of The Pulse and Leaders with Lacqua at Bloomberg and host of the In the City podcast as well. She does so much more. I don't think you ever sleep. I know how you work.
Like you both.
Good to have you here. We're so glad we could get some time with you. We want to start macro. We're just curious, with the U.S. war in Iran, we're now, more than 4 years in on the war between Russia and Ukraine. There's a lot going on in terms of geopolitical and the macro. What's the mood at the spring meetings? Because I was thinking a year ago, we were just kind of talking a lot about President Trump's tariffs. But tell us about what you're hearing and what you're seeing.
Well, hi to you both. You really made me laugh when we were talking about the markets, because there is this idea that actually the markets are fine. Actually, they're even higher than were in January, but the world economy is not. And if you look at the IMF, and if you look at the last 6 years, the IMF World Bank meetings, it feels like every 2 years there's something that could go wrong. Remember, 2020, it was COVID. 2022, it was the Russian invasion of Ukraine. That led to a massive energy spike, especially problematic for Europe. And then we had the tariffs last year, and this year it's the energy mess and what's going on in the Middle East. So if you speak to a lot of leaders, and especially the finance chiefs, they feel like they can't really catch a break. And if you look at the fiscal positions now compared to, for example, 2020, where we were in the middle of COVID, they just don't have that money because of budgets to help support a lot of their citizens. So there's that. And then if you look at the biases for central banks, we had this great long conversation with Christine Lagarde. It's very tricky because you don't really know when Iran ends. You don't know how it ends. It's uncertain and it fluctuates a lot. And at the same time, markets seem to think everything's okay.
Yeah, I want to go back to that conversation you had with her, Francine, because we played some sound. She said the big clouds on the horizon, she sees clouds. The captain is not going to leave the ship. What else stood out to you from the chat that you had with her?
So, Tim, it was, for me, very interesting because when you look at central banks, I've been covering central banks for over, 15, 20 years. And if you're at the European Central Bank, I remember like 7, 8, 9 years ago, it felt like a difficult world. But with hindsight, it was much more simple than it is now because interest rates went up or down, and they used to talk about risks to the upside and risks to the downside. Now, given how difficult it is to predict the world economy, the European Central Bank, but others, including the Bank of England, talk about scenarios. So the ECB made it very clear that it's not, either it goes well or it goes badly, is that you have to look at scenarios like baseline, what we're living through now, something called adverse, which is, we maybe have some kind of peace deal, I guess, in the next couple of months. But again, it's unclear to the markets what an adverse scenario means, or severe. This is full-blown war, from here, which also means that the energy markets are completely unended. And so even if we had a ceasefire, it'd take months, if not years, to go back to normal. So the ECB now thinks in these kind of possibility and scenarios. And I simply asked Madame Lagarde where she thought we were. Were you in a baseline right now? Is it actually much harder and more difficult than they thought she'd be? And she said, look, it's between a kind of, adverse and a baseline. And so it's unclear what happens to interest rates. Remember, there's an ECB press conference with a rate decision, which should be live April 30th. And if you look at the inflationary pressures, the numbers that we're seeing now, but especially expectations for inflation, there's possibly a bias for tightening around the world, but it's not something that Christine Lagarde would be too drawn on.
Yeah, that's kind of interesting, right? I feel like you get so much of that, Francine, from leaders right now. They're really, it's interesting as we start to go through earnings, like how much they commit to the outlook and giving forecasts. Before we go and wrap up, I'm just thinking, what you feel like is, is there a general narrative from leaders as you talk to them? Are they, uncertain? Are they more optimistic? Are they more pessimistic? I'm just curious if there is a narrative that you feel like you can take away, or it's just all over the place.
No, so I don't think anyone's optimistic at the moment. I think people are trying to keep a level-headed, but I think they watch for 5, maybe more disturbing factors. I think they're definitely worried about interest rates. If you're a central bank, you're not sure what you do next. But also, if you're a chief executive, you worry about interest rates, again, going up and what that means for your financing. So I'd watch for the Middle East fallout, look the central bank policy leaning, the scale of IMF support. So we are seeing also more countries needing programs. So that's something that we'll touch on. Fragmentation and deglobalization is something that we haven't touched on too much. But again, when I have a lot of these conversations with these leaders, it's still on the back of the mind. Like, tariffs have not really gone away, and you're trying to find trade routes. And then finally, look, private credit, private markets. Again, if interest rates go up, you could have something, if not fishy, but something more to worry about in that space.
Yeah, I mean, so well setting us up for the next 2.5 hours here, because we're going to talk about private credit. We're going to talk about these other things that have certainly been on the minds of investors. We were so hoping we could catch up with you. So glad we could. Great to have you here on this side of the Atlantic. Francine Lacqua, great to have you here. And we'll be following her reporting of all things out of these meetings. She, of course, is host of The Pulse and Leaders with Lacqua at Bloomberg, and host of the In the City podcast as well. She does so much. It is constantly talking to global leaders,
in
business
multiple
leaders,
languages.
In multiple languages. She is the queen.
Hey, let's get to a view on markets. Back with us is Alli McCartney, Managing Director of Wealth Management and Private Wealth Advisor with Alignment Partners at UBS. It's just over $1 billion in assets under management. She joins us here in the studio. So, failed peace talks over the weekend, yet a lot of people thought on Monday we'd see oil shoot higher. And as a result, here we are another day into the week. And investors are essentially saying, wait a second, we're going to look past this. We're optimistic about this. Stocks are erasing all their losses since the war began.
Plus, it's likely that today we close at another all-time high. I think the thing to remember is that markets and pendulums tend to overswing, and what we are seeing right now, largely driven by a lot of short covering, I think from a technical perspective, is a euphoric market that seems to have gotten the message that a 17% earnings season is extraordinary and should not be forgotten. But I think the conversation you just had and your cautious tone in how you opened with me, I think that the macro outlook is a lot more complicated than this market momentum would suggest.
Alli, what do you mean, though, specifically? Oops, sorry.
So,
I need to jump in.
Again, here we are, again, having erased all of the short, medium, and long-term anxiety and legitimate macro effects that a clear change not only in long-term regime of energy, but a short-term price shock will have. So, so although there are, and it remains, we think the bull market absolutely remains intact, and there are myriad tailwinds, there are also some headwinds that we have to be conscious of. So having, as we said, having come back to now be positive on the year and having retraced everything from this crisis it is a point in time, just like the nadir was a point in time.
But oil's 60%, still 60% higher than it was at the beginning of the year. Why is the equity market seeming to ignore that?
So again, I want to break out the fundamental from the technical.
Okay.
So the technical is that markets, from who owned them perspective, let's put retail to the side, professional money managers were underinvested, and they were largely short. That was making up their gross. And so with this movement upward, they had to cover. Look at how software is outperforming, for example. That is a clear short covering message as opposed to fundamental long-term commitment.
So the point is, investors were so negative because of the war on the equity that all of a sudden when things started to improve, or it looked like we had some peace talks and you started to see the market run up, it was a ton of short covering. But again, markets are fickle, and we just had the banks report.
Right. And the banks reported what one would expect to see in a very volatile market, which was a 5-year high in trading revenue.
Right.
So again, there are a lot of tailwinds. We have we're expecting 11% earnings this year. Banks continue to show resilient companies, resilient individual investors, resilient consumers, but you cannot ignore a 60% rise in energy. I would say you can ignore it less or look through it less for the US than you can Europe, than you can China. So there may be some absolute tailwinds and some relative ones to the US market as well.
I think what's so challenging for a lot of people, Alli, looking at what's happening between the U.S. and Iran is the amount of distance between the objectives of these two different countries. Yes. One is about no nuclear enrichment, or maybe no nuclear enrichment for 20 years, according to the latest reporting. Mm-hmm. The other is let us enrich. How do, like, I just don't understand, and we're talking about this from the perspective of markets, and this is certainly, no question, a humanitarian crisis in so many different ways. But how, if the negotiations are that far apart right now, how are we even talking about some sort of resolution?
So I think that the way markets are looking at this, which may be very myopic and certainly is from a long-term infrastructure, humanitarian, and ideological perspective, is that both regimes want to negotiate. And so that in itself becomes a de-escalation and takes of the entire curve of what could happen here, best case to worst case. From a market perspective, worst case is off the table. And so that optimism, in addition to short covering, in addition to earnings season, seems to be driving price action. But again, I truly believe that this momentum is masking some long and medium-term economic issues.
Well, I love that you go there, and it's something that Tim and I talk a lot about because we've spent so many conversations, I feel like, over the last few months, especially with the war, but even before that, about the grab for, I keep going to this, raw materials, natural resources, supply chains that have to be secure, redundant. And I think about this with energy. Yeah, U.S. is in a good position, but the whole world is rethinking, wait a minute, I got to make sure I'm not in a tough position going forward. I feel like that is going to just drive prices higher on things because you have maybe double supply chains, or you're doing things domestically at home that, you know, you do stuff in the U.S., it's going to cost more.
This is a continuation of a lot of trends that we've talked about with the beginning of the Trump administration and a sort of restacking of the rules of the road and the geopolitical deck. One is general self-sufficiency and security, whether that's cybersecurity, whether that's energy security. The other is the removal of the peace dividend. So I think what you are about to see in the upcoming years is a seismic shift in the way countries and companies think about energy. And so if I look at it from a short-term perspective, yes, even with the run-up, I would continue to own energy. And if I look at it from a medium...
In all its forms?
And if I look at it from a medium to long-term perspective, it makes me more bullish on solar, on nuclear, on any sort of, like, everything from the fact that most of our solar paraphernalia comes from China. And so we need to rethink all of that. And so as you think about the changes of the rules in the road and how we act as the police of the world, as you think about the tariff concept, as you go back again to 2020 and 2021 and the pandemic and the necessity to have local control and ability to manipulate your own supply chain, all of those things go to increased onshoring and industrial production in this country and every other country.
On that, Oracle agreed to buy as much as 2.8 gigawatts of fuel cell power from Bloom Energy to supply data centers for AI. And this is someone that works in nuclear energy, right? Like, we've had these guys on, and I mean, it's not happening yet, but they're working towards it. Yeah, there's so much of this going on. Amen. I think last time there was so much going on, we had to reschedule. Thank you for coming in.
Absolutely. Good to see you both.
Always good to have you here. She's Alli McCartney, Managing Director of Wealth Management and Private Wealth Advisor with Alignment Partners at UBS. They've got just over $1 billion in assets under management.
Hey, coming up, what you need to know about the largest U.S. banks' latest results and the big bank sector overall. JP Morgan, Citi, and Wells Fargo.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. We're off session highs, but still looking at solid gains for the Dow, the S&P, and NASDAQ. S&P right now up 62. That is a gain of just about 0.9%. The Dow up 231 points. Dow Industrials up 0.5%. S&P, by the way, so far this year, up by roughly 1.6%. NASDAQ having an up day, up 1.6%, with the NASDAQ 100 index up another 1.4%, up yet again. We've got the 10-year currently yielding 4.25%. This against the backdrop of a VIX at about 18. Spot gold up almost $100 the ounce, up 2%, $48.36 on the precious metal, while West Texas Intermediate crude is now down 7.5%, $91.60 a barrel on WTI. Brent, $94.65 barrel of Brent, down now by 4.7%. Again, the Dow, the S&P, NASDAQ, they're all advancing. In the airline industry, sources tell Bloomberg United Airlines CEO Scott Kirby has floated a possible combination with American Airlines to senior government officials. Shares of both carriers are advancing. United up 1.9%, American up 7.4% among other carriers, Delta up 6.5%, JetBlue is surging 14.1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Cullett. Tim and Carol, that is our Bloomberg Business Flash.
All right, Charlie, thank you so much. Charlie's been talking about it a lot. We all are because, earnings officially off and running. 3 more of the big banks reported, as you know, including the dominant U.S. bank, JP Chase. Shares, though, of JP they are trading lower today, even as traders there posted their highest ever quarterly revenue in the first 3 months of the year. So, too, are lower shares of Wells Fargo as it missed lending estimates, and then there's Citi.
Yeah, buck the trend. Citigroup logs its best returns in 5 years, driven by a wave of market volatility. Weighing in, though, on today's credit cycle, a key voice in Wall Street, somebody that we know all of you listen to, including us, JP Chase's longtime CEO, Jamie Dimon. He talked earlier on the call with analysts.
There will be a credit cycle one day, and I think when there's a credit cycle, losses will be worse than people expect relative to the scenario. I don't think it's systemic. It almost can't be systemic at that size relative to anything else.
Well, Jamie Dimon said it. I mean, listen, he's watching this. We know he's talked about cockroaches when it comes to private credit and concerns. That, of course, was Jamie Dimon of JP Chase earlier with analysts on their earnings call. Hey, let's get more, though, on the bank results. We've got a great key voice here, right here at Bloomberg. He is Bloomberg Intelligence senior analyst. He does cover the U.S. banks. He is Herman Chan. He's been up bright and early this morning covering the banks for us, and he's here in studio. Good to have you here. We know a long day. Let's start with JP because it seems to be a benchmark for the world, for the street. Traders there did great. JP though, did lower its full year net interest income guidance. That's a key metric we know. Why is that bothering investors so much?
Yeah, I would contend that it shouldn't bother investors that much because there are offsets to that NII guide, net interest income guide, where the fee income stream will be higher to offset the lower net interest income on a reported basis. Importantly, the core net interest income of $95 billion is stable and has been over the past quarter. So all in all, we think the quarter was great. You mentioned the strong markets and trading results. That was above their initial outlook. So really good strength across the board.
We'll talk more about some of those other areas of the business, but you know that I always go to you for commentary about the consumer. And Bank of America's tomorrow, JP was today. JP has a great view on the consumer with Chase.
Right.
Any commentary about spending and higher energy prices weighing on consumers?
Yeah, they did mention that. Wells Fargo mentioned that higher gas pump prices are increasing the spending on the totality of the spending about 1%. So let's say it was 4% previously before the issues in the Middle East. Now it's 5%. So that being said, the other spending patterns haven't really changed much, and the bank's management teams have said that it takes a bit of while before the consumers really react to some of these exogenous events. So if the higher energy prices stay, then you could see the consumers pull back more in other areas.
Let's go to Citi, because definitely the outlier. And we saw Citi rallying in today's session. I think it's right now up about 3.5% here. I mean, who'd have thunk? But we know they've been evolving. What's the Citi story quarterly, the latest update, and longer term based on what we're seeing right now?
Yeah, we saw strength across the board in a number of its businesses like services, banking, markets, wealth, all up double digits on a revenue standpoint.
Well done, Jane Fraser.
Well done, Jane Fraser. Their return on tangible equity target is 10 and 11% for the year. They cleared that 13% in the first quarter. And then they talked about their ongoing transformation. working with the government and making sure their books are in order. That's about 90% complete versus 80% last quarter. So they're taking really tangible steps of improving the business.
So 100% complete at the end of this year, next year?
Management did not give concrete numbers, but we have an investor day for Citi coming up next month. So we'd expect more color there in terms of what they have done and what still needs to be done. They did say the timeline is really dependent on the regulators. So they are a bit beholden and don't control everything.
So far, so good. 30 seconds left. We're on to what? Morgan Stanley tomorrow?
Morgan Stanley and Bank of America tomorrow, and some regional banks as well. We'd expect the continued strength on trading across the board. But really, it's going to depend on some of these puts and takes, like net interest margin for Wells Fargo, and then the guidance for the upcoming year.
We're off and running. And so far, though, pretty
yeah,
good,
so
right?
So good. Strong results all across the board. The market's just nitpicking a little bit in our view.
They're always so it's always just, they want more.
It's always
something. It's always something. Herman Chan, thank you. Bloomberg Intelligence Senior Analyst covering U.S. banks for us.
Well, we're going to stay on banks and more of what's coming at investors and how to invest through it or in it. Joining us now is Joe Hegener, founder and chief investment officer at the Registered Investment Advisor and alt investment manager, Asterozoa Capital, about $150 million in assets under management. Joe, good to have you on the program. I want to continue the conversation that we just had with Herman and talk more about the banks. You're bullish on JP Morgan, you're bullish on Goldman Sachs, Morgan Stanley, which, as we just mentioned, reports tomorrow. What makes these banks attractive to you?
Sure. Yeah. Thanks for having me. I think both the cyclical as well as the secular, the longer term setup is incredibly favorable for the large banks, investment banks, and as well as insurance companies, right? You guys just spoke about it a little bit before as it relates to the quarterly financials. Kind of from a macro standpoint, we believe that the yield curve over the next 12 months, 18 months is set to steepen, a bit further. We'll get some rate cuts. The long end of the curve might go a little bit higher from here. That's a net, huge benefit to net interest income and net interest margins for mortgage REITs, for banks, anybody who borrows at the front end of the curve and lends at the longer end of the curve. And something that we think is actually somewhat underappreciated on a secular basis, a longer term basis, is the incorporation of technology, automation, and AI, and what that does to improve margins across corporate America, right? I mean, an example that I give every once in a while is Morgan Stanley spends $26 billion a year in payroll and benefits. And, a nice age ago, I used to work on the institutional side of the business at a couple of large asset managers. And if just 10% of the middle and back office function could plausibly be automated through the use of, AI tools and automation, then, what does that actually do to the net interest margins of some of these very profitable banks? We're looking at potential 20% net interest income, or rather net interest margins to maybe 30.
Right.
Well, maybe.
So hooray for them.
Well, Joe,
but
yeah, I mean, it all sounds great if you're an investor in the company, but if you're one of the 10% of workers whose tasks can be automated, are you out of luck?
Yeah.
In a word.
Unfortunately, I do think that is the trend. I'm definitely not commentating on a socioeconomic or kind of humanitarian standpoint. I'm purely talking about corporate earnings and the very significant secular tailwind that exists behind, what we think is going to be an exponential compounding of said earnings.
Okay, so we're going to put the human element aside for a moment, if we can. But listen, we're trying to figure this out, right? And if you run a publicly held company, a bank or other, fiduciary responsibilities, you're always looking at cutting costs, and it comes in all different ways, whether it's through software or programs, AI, or shipping it out overseas. This is not a new story, right? It's a long time story. We mentioned some of the names that you like, Joe, Goldman, JP Morgan, Morgan Stanley. Do you have a favorite among the group? And is there anything that you're seeing so far in earnings that maybe changes your opinion on them?
I would say Goldman and Morgan Stanley in particular. The kind of the wild card with both the investment banks, right, is this the profit potential from the sales and trading department, and that's a lot less predictable than, say, wealth management or kind of traditional lending business that like JP Morgan, for example, is so entrenched in. The volatility we've experienced over the last quarter or so, it could really break either way. It's kind of my view that the FICC sales and trading departments might have a tendency to underperform and lag relative to the equity business. Just at a very kind of high level, anecdotally, as somebody who participates in sales and trading with various, sell side banks, FICC tends to kind of seize during periods of volatility. Corporate and securitized products, those trading volumes tend to decline during periods of volatility, whereas it's actually quite the opposite for equities, right? So like Morgan Stanley, for example, has done a great job of building out their equity sales and trading department over the years, and I would expect to see some fantastic numbers from that division. Whereas, there might be some weakness in FICC, but overall, I mean, these are such well-run, very, very efficient businesses that I expect to see solid earnings over the next handful of quarters.
Joe, we don't have a ton of time. We want to talk private credit. No big red flags in aggregate credit loss provisions from the 4 banks that have reported so far, including Wells Fargo. You say not all is well when it comes to private credit.
I think that the sheer volume of inflows over the years inevitably leads to risk taking that got over its skis. I mean, you can't possibly put $2 trillion to work over the course of 7-8 years and do it in a way that's, in my view, responsible from a risk-taking standpoint. And so there are inevitably going to be winners and losers here. The problem with private credit, though, right, is that it's sort of a black box. We really are only now starting to see write-downs from some of these managers. I think that trend, very much continues, and it's like that old Warren Buffett saying, right? You only really figure out who's been swimming naked until the tide goes out.
Yeah, no, absolutely. And we highlighted a soundbite from Jamie Dimon on the earnings call today that he said there will be a credit cycle one day. And I think when there's a credit cycle, losses will be worse than people expect relative to the scenario. I don't think it's systemic. It almost can't be systemic at that size relative to anything else. And I think there is some perspective about comparing this to the great financial crisis, and people are pushing back. But I guess time will ultimately tell in terms of exposure. But we also have a lot of folks come on and say, you got to read the prospectus. It's very clear that these are not liquid investments. And so anyway, we got to run. Good to check in with you, Joe, and hopefully we can catch up once again in the near future. Joe Hegener, he's founder and chief investment officer at the RIA and an alt investment manager, Asterozoa Capital.
When we come back, Emily Green, head of private wealth management at Ellevest, here in the studio. That's next on Bloomberg Businessweek Daily.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got stocks advancing. The Dow, the S&P, NASDAQ very much in the green. We are off session highs now with the S&P at 69.54, up 67. That is a gain there of just about 1%. Now the Dow up 288 for the Dow, a gain of 0.6%. S&P, by the way, with today's advance, now up by roughly 1.6% on the year. NASDAQ up 389, higher by 1.7%. The NASDAQ 100 index keeps on going up for yet another session, up 1.5%. The VIX just above 18, the 10-year 4.25%, the 2-year 3.75%. Gold is up $98 the ounce to $48.38, up 2.1%. And West Texas Intermediate crude oil 91.56 a barrel, down 7.6%. Barrel of Brent below 95 now, lower by 4.4%. Deal news: Amazon has agreed to acquire satellite operator Globalstar in a roughly $11.6 billion transaction that would boost the tech giant's efforts to build its own satellite operation. We've got Amazon shares now up by 3.95%, all part of a broader tech rally. Shares of Globalstar, they are surging by 9.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. Tim and Carol, that is a Bloomberg Business Flash.
All right, gotcha, Charlie. Thank you so much. Well, over the past year, we've kind of mentioned this a lot, but it's, I think, worth repeating, and that is women are controlling ever greater sums of money around the world, setting the stage for major shifts in wealth management and philanthropy. And if you look at some of the numbers, especially in the United States, pretty impressive.
Yeah, McKinsey expects women to control $34 trillion. That's about 38% of investable assets. That's by 2030. That's close to double the total just last year. That figure was just $7.3 trillion, or 29% 10 years ago.
Yeah, big bump. And the biggest drivers of those gains is just a simple demographic trend. We're talking about women of the baby boomer generation outliving men by 5 years on average. Rich husbands are increasingly leaving their wives in control of family fortunes. It's as obvious as that.
Well, it's time now for our weekly Women, Money, and Power, where we speak with some of the most influential women from across the business world. It's great to have back with us Emily Green, the head of private wealth management at the Registered Investment Advisor, Ellevest. She joins us here in the studio. Are these conversations the ones that you're having right now with clients because of the demographic shift, the great wealth transfer, and where we're expecting money to go in just the next few years?
Yeah, I think it's interesting because we really see it happening. And so we do a lot of marketing. And so we have a lot of people who even just like write into our site. And so you see a lot of these widows. And so the numbers that you're talking about here, like of the great wealth transfer, 40 trillion of that is actually supposed to be to women that are baby boomers or older. That's an enormous amount. And so we're seeing that coming through when we're talking to clients. And then the inheritance conversation, like people are just having it more now. And so you see that older generations weren't having that conversation. You let someone die and kind of when someone's going through grief, be like, okay, now we have money and we need to figure this out. And that's when you kind of learned everything. And it's really changed over the past few years.
So tell us about those conversations and those outreaches of what people are asking and then what you guys are doing.
Yeah. I think it's interesting because, when we think about there was a recent study that 53% of women are now the CFOs of their households. But it is generationally very different. 63% of millennial women are CFOs of their household, but on the other side of that, it's 45% of boomer women. And so that's a big difference. And so it really depends on generationally where someone sits when you're having this conversation. And really people are trying to figure out what that looks like next for them.
So what are the challenges that come in the context of somebody who's not thought of or doesn't think of themselves as the CFO of the house suddenly becoming CFO of the house?
Yeah. Well, a lot of times it's just shock. They don't even think about it. Tomorrow is April 15th. They don't even know how to do their taxes within there. You kind of go through all of this. And so you're suddenly burdened. And it is like money is not always an easy thing. And so they suddenly have to take over all of this control of doing your taxes, thinking about the investments, what's going on with the markets. Think about if it's happening to you right now with what's going on in the markets and you've never you've never looked at what volatility in markets is, and you're now logging into your account, looking at the ups and downs. They don't understand that. And so it's this big learning curve of just what does this even mean? What does this mean to me? And what does this look like for my future?
Emily, what does it mean in terms of men versus women in terms of what they want to do with that money?
Yeah. So, there's been all these studies, and you probably talked about this, that women look more to their values. I like to think of it, I think that a lot of times those studies were taken as more of like ESG investing.
Yeah.
I actually like to take it in a broader lens that they want to live their life along with their values than just their portfolios. It's really person to person of like what ESG even means. So let's take a step back from that. And we use the term wealth care. And so rather than thinking about just what number you're going to die with, because I always think about like who cares about your legacy? Like every financial firm they do this report for you and you look at like how much money you're gonna have when you die, but like who cares that day? And so it really is about like how much are you actually
Well, I do kind of care.
Well, you're dead at that point. Your family cares, but you don't know.
That's true.
And so you care about, can you buy that house? Can you go on vacation? Can you do those things? And those are people's values. And so what are those trade-offs in life that you can live your values with?
Yeah. Well, it does seem increasingly we're hearing this idea of, quote unquote, giving while living and not necessarily saving that money for your heirs when you are no longer around. Talk to us about that transfer.
Yeah. I mean, you see people giving more money to the next generation while they're alive.
Which has tax implications. Like
yes, it does.
You can't just give your money away to your kids.
Yes, because you don't get the step up in cost basis if you're just gifting assets. And so that's something to continue to think about. But you do look at that the lifetime gift exemption is quite high right now. And so that's also part of the reason you're seeing this. And so you see people who have, these levels of wealth actually doing that. that. And it's like training someone about their money before they get that. We see this with clients all the time. We have this conversation with clients like who have kids really in their 20s and starting to say, let's start to gift them some money each year. And maybe it's just the annual gift exemption to begin with, but like, so you can experience what's happening in the markets. And so that you don't end up in a situation where the markets, you have the Iran war start and you sell everything because you're terrified. Because look at where we are now.
Right. I gotta say my parents did some of that. And I see my large family, older siblings, like looking at their kids, getting married and being like, you need to buy a house. Like things that you would want to do now rather than wait to help them out, that giving while you're living. I kind of think that's an interesting concept.
Oh, I think your daughter's calling. Interesting. That's so interesting.
Oh, no, she's been blocked. She's had all our money already. That's so funny.
Sorry, derailed you.
It never ends. What is it, though? Because we talk about these stats over and over again. I love that you actually have the real, the people calling and doing. What is it that we maybe don't understand when we see these big, broad reports and we see these numbers that you think is important for us to understand, this audience to understand about this?
Yeah, I think that one of the most important things as we go through this generational wealth transfer will be women really taking control of this money. And so one of the interesting things that we've seen, and we look at all these stats all of the time, is actually how confident women feel with their money. And I think this is really interesting because you see that women are actually less confident than they were 5 years ago. And so they have more money than ever and they're less confident than they've been.
Why?
And so what does that mean?
Yeah.
And so when you really look at the financial industry, how are they serving them? And so, I think a lot of times look at the financial industry and people try to fit them into the box that exists. And it really is, you need to change the box in the way it is and how that you actually serve these clients, not fitting them into what's existed for 50 years.
I'm going to get so much flack for this, but I'm hearing also a message for men in what you're talking about.
Oh, definitely.
And the message is you need to be inclusive in the way that you think about this with your partner.
Yeah.
Because you don't want to leave them in a situation where they don't know what to do.
Yeah.
And statistically speaking,
Yeah.
you are going to leave them.
Yeah. We see this all the time. So actually, we have a lot of clients who are couples and the man is older or just they're even the same age. Men have shorter life expectancies than women. We talk about this all the time.
Yeah.
And they say, we want to be with someone that our wife is going to actually have a relationship with. So when I'm gone, she actually calls the person because we know the stats of the percent of women who leave their advisors the year after their husband dies. It's most. And so when you create that relationship and that comfort, that's going to change the way that they relate to that money and that they can actually handle that when they die.
So first step someone should take, if you think about it, there's a couple out there and they're, older or thinking about the future. What's the first step? Just got about 30 seconds here.
Having conversations with each other on a regular basis and with your family. I call them like money dates, but starting to do that and finding people that you have those conversations with.
Yeah, money's a hard thing to talk about, but you've really got to do it.
It's a muscle. It's like exercise. You got to just keep doing it.
Yeah, exactly. Thanks for coming back.
Thank you.
Really appreciate it. Emily Green, Head of Private Wealth Management at the Registered Investment Advisor Ellevest, joining us here in studio.
As far as how that wealth is doing in the stock market today, the S&P 500 up 0.9% off its best levels of the day. The NASDAQ still up 1.6%. The Dow up 0.5 percentage point. And we come back on Bloomberg Businessweek Daily. Stocks on the move. This is Bloomberg.